Everyone loves to believe the market is invincible until it punches them in the face. Stocks only go up, and only losers take profits. That's what Dave Portnoy said, right after one of the worst market crashes in history. And if you'd followed that advice, you probably learned the hard way that confidence isn't a financial strategy. You see, shortly after Portnoy made his comments, the market tanked, leading us into a year-long bear market. Yet somehow, here we are again. Markets at record highs, social media full of self-proclaimed experts, and a whole new generation absolutely convinced they're investment geniuses. Alan Greenspan had a name for this: irrational exuberance. But let's put it simply, the market is overvalued, and dangerously so. Before you think this is just fear-mongering, look at the numbers. Specifically, the Shiller PE ratio, one of the cleanest ways to measure whether the market is cheap or stupidly expensive. It compares today's stock prices to 10 years of inflation-adjusted earnings. The historical average? Around 16 to 17. When it drops below 10, the market is cheap. When it climbs above 30, the market is overpriced. Well, today, it's over 40, higher than it was before the crash of 1929, and getting dangerously close to the levels we saw before the dot-com explosion in 2000, when the Nasdaq fell nearly 77%. If history doesn't repeat itself, it definitely rhymes. And this rhyme sounds familiar. Now you've got people arguing about whether we're in an AI bubble. Bill Gates says yes. Jerome Powell says no. Only one of them is going to be right. And right now, the Shiller PE ratio is leaning toward Gates. But let's make one thing clear. This is not a prediction of an immediate crash. No one is saying the sky is falling tomorrow. What we are saying is simple. The market is overpriced, severely expensive, running hot, and even a healthy correction would be good for everyone, especially the retail investors who think today's prices are normal. This is exactly why seasoned investors have been shifting their attention toward dividend-paying stocks. Not hype stocks, not meme stocks. Real companies with real cash flow that pay you even when the market cools down. But the overvaluation problem isn't the only threat investors should be watching. There's another global pressure building, one coming from halfway across the world. Rare earth elements. The 17 obscure-sounding minerals you probably never think about. Neodymium, samarium, terbium, dysprosium. The list goes on. They're inside your smartphone, your EV motor, hospital MRI machines, fighter jets, missile guidance systems. Basically, everything a modern society and modern military depends on. And here's the catch. Almost all of it comes from one place: China. While the rest of the world spent decades debating environmental policy and mining regulations, China didn't hesitate. They mined aggressively. They dominated supply. And today, in 2025, 3 Chinese state-run companies control most of the global rare earth market. And Beijing is tightening its grip even further. Starting December 1st, any company exporting goods containing more than 0.1% of China-sourced rare earths must apply for a government license. That is a massive choke point on the global supply chain. Goldman Sachs already warned that even a 10% disruption could erase hundreds of billions of dollars from the global economy and damage everything from semiconductor chips to EV production to military technology. Think about this. An F-35 fighter jet contains over 900 pounds of rare earth elements. That means America's most advanced aircraft, the one meant to defend the country, relies on materials controlled by its top economic rival. China is effectively holding the keys to industries the U.S. can't afford to lose control of. So when China tightens restrictions, the ripple effects are immediate. Rare earth stocks outside China started exploding upward, but most of them are small, foreign, or hard for U.S. investors to access. That's why analysts have started looking at domestic alternatives with real potential. One company in particular, a U.S.-listed mineral development firm, has been gaining serious traction. They're focused on mining rare earth elements and creating materials for industries like aerospace, automotive, and advanced energy systems. The company has a market cap around $800 million. The stock's up nearly 350% this year. It hit a 52-week high of $12.58, dropped as low as $1.27, and as of this message, it now trades around the midpoint near $6.59. It's volatile, it's gaining momentum, and it's positioned directly in the middle of one of the most strategically important battles between the U.S. and China: resource control. For investors who understand geopolitics, supply chains, and long-term demand, plays like this are becoming more than just interesting. They're becoming necessary. And that brings everything full circle. While retail investors are celebrating record highs and posting victory laps on social media, the real opportunities and the real risks are happening behind the scenes. The market is overvalued. Rare earth supplies are tightening. Global tensions are rising. And the smartest investors aren't chasing hype. They're preparing for what comes next. Whether you're exploring dividend stocks for stability or rare earth stocks for strategic upside, the goal is the same: stay ahead of the curve, not behind it. Markets reward preparation, not impulsive confidence. If you want the full breakdown of the exact dividend stock and the specific rare earth play analysts are watching, the complete research is available exclusively to email subscribers of the Alpha Edge Digest. But no matter what you choose to invest in, remember this: bull markets make everyone look like a genius until they don't. Stay sharp, stay disciplined, and always look deeper than the headlines.